From Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew Armihan alongside my partner, the Professor Luigi Rosa Bianca. What's on tap today, Lou?
Now, today we're going to talk about your and my greatest pet peeve. Small business owners that give absolutely zero attention and focus to the underlying finances of the business. If you don't know what a P&L is and you don't know what a balance sheet is and you haven't reconciled in months, this podcast is for you. Today we have Chris Mannina, president, founder of the Mannina Group, tax strategist at large. Chris, let's just start from the very beginning. Small business owners, give us the top 5 must-dos and don'ts in starting and scaling your business. Welcome to the podcast, Chris.
Thank you so much. I really appreciate you guys having me on today. I think that every small business is at a different stage, but I start to think about it in terms of a financial maturity model. You know, where are you in terms of your processes overall? What kind of metrics are you using to track your business? Are you tracking certain metrics? So if you ask for 5 things, I'd say the first thing you want to jump into is automation. What are you automating and what are you not automating in your business, especially on the financial operations side? Today, there's tech stack that you can build out to do everything and really take a lot of the manual effort out of just about every single transaction process you're dealing with, so that you can really reduce the level of effort into that processing of data and spend more time analyzing data. I mean, that's what you think of accountants as doing historically, is a lot of the processing, right? Financial reporting. But when you can do all that processing in an automated way, now you can spend a lot more of your time doing the analysis, trying to understand what the drivers of your business are. The second thing I'd probably say is for the CEO or the board, both probably, to be sitting down and spending time with their CFO to really understand what the levers are in driving the business. You know, what does your cost structure look like? What's your break-even analysis if you're not currently profitable? What are the drivers there? I think of it a little bit like a car, right? So you as the CEO want to get in and drive your car. You want to be able to turn left, turn right, know that the car is going to go that direction, punch the gas, slam on the brake, but you're not necessarily in the weeds trying to understand how the mechanics of the engine are working, right? So what we're doing is we're getting in and understanding how all the pieces fit together, understanding what levers we can pull to help drive profitability, look at profitability by division, by project, by, what service line, and help you understand how it all fits together at a high level. So you're not in the weeds, but you understand how all the mechanics work. Those are a couple. I can keep going as long as you want, but
So Chris, let me ask you, you do CFO services, right?
Yeah.
A lot of people that listen to this podcast are just starting out. They probably don't need that right away.
Right.
They got to start somewhere. But at what level should a business start thinking about bringing in outsourced CFO services into their company?
So I'd say that every small business should do it immediately, but not at the scale you might think. Like on a very, very fractional basis, I would say every small business should start with having somebody that they can go review their monthly or quarterly financial statements with, so that they can talk through what's going on. And that might just be a couple hours of somebody's time once a month. It's not cost prohibitive. The other thing I think that they should do is use an outsourced CFO, probably to do a forward-looking cash flow projection. Those things where you can do cash planning. Even as a small business, it's helpful and it's not cost prohibitive. If you're only taking up somebody's time that's 2 to 4 hours a month, you're not going to be breaking the bank, but you're going to get a lot of visibility into your business, and you're going to have a lot of ability to sit there and talk with somebody who's really got the insight into your business, into your industry, to understand those moving pieces. So even if you're not necessarily bringing somebody in to manage your banking relationships, your financial operations, and all the compliance, even if it's just a very, very, very small scope, to sit there and help build out not only a cash flow projection, but do that review on a monthly basis, I think that's the starting point. Everybody should have that skill set in-house.
I totally agree with you 100%. You know, we work with a lot of small businesses over at our company too. And one thing that we find, and people need to be told this most of the time, is they think their accountant that's filing their paperwork is
Right.
doing all this, and they're not. The majority of accountants out there are reactive rather than proactive. And I think you and your firm would fit in the proactive space.
Yeah. I mean, I think that that's the other thing that I would just advise smaller businesses to do is you use the words reactive and proactive. I've always thought about it as looking backwards and looking forwards. Like a lot of people end up looking at their finances, what's happened already. You know, we're closing the books. We're looking at, July's financial reports mid-August. We're going through all that history. You understand what did happen, but you're not going to run your business well looking in the rearview mirror. You want to be looking forward. You want to be looking at having a good framework to make assumptions for the future, do projections, and start to build those out. So you really are looking the right direction. You got to make sure everything's done properly historically, for sure, but that's not where your focus should be. I think you should be constantly looking forward, because if you're not, you're going to miss something big.
Chris, Matt, I'm hearing everything you're saying, but I've got a buddy of mine who's out of the Phoenix area, and he's making a killing in the pool business.
Okay.
He's making many, many zeros, and he drives around with his Ford pickup truck every day, going from homeowner to homeowner, picking up his envelope of cash.
Right.
He's got his little leather ledger inside his glove compartment, and things are just groovy. He's on his fourth wife. Everything is fine. Why do I need to put in all these protocols? And why do I have to hire all these fancy people and get this software? I mean, I'm making $10 million a year. Why do I need to bother with all this stuff?
Well, I mean, I'd say, like, what are you optimizing for, right? Good is the enemy of great in a lot of ways. It's running well. Things are good. I hear you. That's wonderful. But could it be better? Could I take a lot of the headache off your plate and reduce the time that you're spending on things? Wouldn't it be great to make that same amount of money and not have to do half the work that you're doing? There's book 4-hour work week. How can you optimize the hours that you're using? I think about it like that. Like, we can take a lot off your plate and reduce a lot of headaches. Additionally, there's a lot of opportunity for us to look at the data and coming in. Maybe you're making 10 million a year, but maybe you should be making 15. Maybe we can optimize certain things. I mean, just because you're doing well doesn't mean you're doing as good as you could be or efficiently as you could be. I mean, I think that optimizing is always a thing you should be striving for and trying to improve, iterate, get better over time.
So let's just say this same friend is hearing what you're saying. How would you go about integrating technology and your systems and processes into his existing model? I mean, I know the first month will probably be a heavy lift.
Yeah.
I would imagine it'll probably be a lot of fun.
Yeah. I mean, that's what I get excited about, coming in and looking at a business, understanding what's going on. What we do is we're going to come in first and do an assessment. Basically, what we're looking at is we're looking at your processes, you're looking at your controls, looking at all the reporting you're doing, what kind of KPIs you're looking at, how you're benchmarking your business against other businesses, and just sort of a gap analysis to say, here's where you are, here's sort of the optimal industry best practices, and sort of create a roadmap of how we've got to get there. I think that's the best process for us to come in and do it. But, that might be 30, 60, 90 days. And then, implementation of that, maybe another 30, 60, 90 days. But over the course of 3 to 6 months, we can come in, clean you up, improve your processes, automate what we can, and really make things as tight as they can possibly be so that you do get those efficiencies. And maybe you're not spending 10 hours a month on admin type efforts, or maybe it's 20, 30, 40 hours a month. I mean, those are the areas where we can create a lot of ROI for business owners, because if you aren't spending those hours on those mundane admin tasks, those are hours you can either take back for your personal time, or you can build your business to a greater extent.
You are definitely speaking my language. And one thing I want everybody to think about is, if we're doing it the way in Lou's scenario, what happens when you get a little long in the tooth, as my partner likes to say, and you want to retire and you want to sell that business and nothing's optimized?
Yeah. I mean, you're going to have, anytime you're going to sell a business, you're going to come in, you're going to have bidders doing diligence and all this. It's a big headache and it's a big process. And, the thing is, as your data is unstructured. You don't have great answers to their questions that they're asking. Your processes are a mess. They're going to come in and say, I don't know what I'm getting here. I don't know if I want to buy this, or I don't know if I want to buy it at the price point you want to buy it. But if I can come in and I have everything humming, it's an easy, cookie cutter. I can transfer this over to this business is now going to become a business unit in your larger firm. It makes it a whole lot easier when you have everything running smoothly. You can answer all their questions. You have all that visibility into your data, and you can talk to them intelligently about your business because you understand where everything is going, because you're spending 50% more time analyzing your business instead of processing transactions and dealing with that admin effort. So it's all a process, but I'd say you also have, when things are running smoothly, you can also spend more time to prep for a transaction. You can spend time talking to your advisors and really positioning yourself, get your balance sheet right, get your ratios right. And so you have a lot more ability to be strategic about what you're doing.
Hey, Chris, me personally, I'm afraid to go to the dentist. I've always have been. I mean, to this day, I probably canceled my appointment to the dentist 4 times before I ended up going. My wife was always at the house. But there are small business owners, and does not apply to your firm. There are small business owners that feel the same way about speaking to their accountants.
Sure.
However, there is that critical conversation that maybe has to occur a couple times a month. S corp versus C corp, cash versus accrual. Do I make this payment in December, or do I roll it over to January? I mean, there are so many conversations that need to occur in that fluid relationship between an accounting firm and the small business that they represent. I mean, what's your sugar-free lollipop to that business owner that makes certain that that relationship is warm and cuddly?
I mean, I think it takes time to build that. And obviously we're in the trust game. Like, I want you to have comfort with me and know that I'm there as your partner to help you build your business better. But I'd say the lollipop is, I'm going to give you insight into your business so you understand the framework of what's going on. You understand how all the levers that we're pulling are helping drive profitability for this project, this department. And you get a lot more comfort in understanding your business. So when you walk away from those meetings, you're like, God, I didn't really realize that's how this is working. Or as we start to have some of these conversations, tax planning, things like that, I know I got a plan for this estimated payment. I know I'm going to have this tax liability going forward. So we got to plan and strategize for that. Sometimes those aren't pleasant conversations because they're like, I don't want to know this check I got to write. Like, that's the last thing people want to deal with is the tax man. But I think the idea is that when we walk away from those meetings, you have a really good, firm understanding of what's going on with your business, and any questions you have or misconceptions are cleared up. And so you walk away from that meeting going, all right, that was a good meeting. That was value add. I feel a lot better about where we are today. It's maybe qualitative, but.
Chris, one thing that no one really understands, because you guys walk around with this really lofty, prestigious title, but the business of accounting can be easy. And you're running a really large firm. You want to share some insights on how difficult it is to run a white collar firm, which may have, high real estate fixed costs and high salaries and very high expectations when it comes to communications. Kind of share with us small business owners the challenges that Chris Mannina has in running this huge conglomerate.
Yeah, I mean, I'd say that running any business is not easy, and there's never enough time in the day to do what you want to do. At the end of the day, I think the people is what you're relying on, right? So finding the right people, putting the right people in the right seats, and finding the right character. I mean, that's the day. If you get the team right, that's the primary piece. There's certainly technical pieces. There's operations. There's reporting. There's compliance. There's everything under the sun, and every time you turn around, there's another problem or headache. But if you get your team right, that's my North Star, right? So I want to find people with high character, who have good work ethic, and who are just pleasant to be around. There's always that one asshole on every team, and they just ruin it for everybody else. And when you can have a team where you just all in sync, working together, you trust each other. I mean, that's the corporate culture that I think is going to help build any really strong team in business. So, I could talk about everything in the detail level, but that's the North Star, is get the team right.
So, Chris, tell us a little bit how you got started. How did you get started to where you are now and even become a CPA?
Yeah, I mean, it was a little bit lost in college, I guess, just going through business school. Didn't really know what direction I wanted to go, but I got into accounting, took a couple classes, and it just like I was using that car reference before. So it all just seemed like an engine to me. Like you figure out how the pieces fit together and you understand how a business works from a financial side. It was really interesting. And then as I got into it a couple years, 3-4 years out of school, just doing this work, I realized how limited, and not in a derogatory way, but like how limited a lot of the C-suite of a lot of my clients were in terms of their financial knowledge. And so there's an obvious gap where just the education for the C-suite was such a value add. That's really what got me excited to go start moving forward is helping businesses understand their business better, helping business owners make better decisions. That's sort of what gets me excited every day. And so, dovetailing from that, you find the right fit, trying to figure out what services you can provide and just build from there.
Now, Chris, just to piggyback on Matt's earlier question, at what level of either revenue or just breadth of business do you recommend bringing your CFO then in-house, right? It makes total sense, your fractional CFO model, but at a certain point,
sure,
you want this guy in the corner office being able to answer your questions every day because there's a lot of transactions going on.
Yeah, I mean, there's no one right answer, I guess, but as your business gets complicated, you start to deal with multiple business lines, you start to deal with multiple geographies, you start to deal with multiple countries. The complexity gets to the point where you need somebody's time, probably closer to full-time, right? So that's really the metric that I'd use is how many hours a month are you using your fractional CFO? If you're getting to the point where you're using 40 hours a month or 40 hours a week or 30 even, that's where you're going to start to see the cost benefit of bringing somebody in-house, because on an hourly basis, we're not cheap. But overall, we're much cheaper compared to bringing somebody in-house, right? So if we're giving you 20 to 30 hours a month, we're going to be much cheaper than a full-time CFO. So that's really the metric I'd use is how much time are you needing from this person every month?
Well, there's value there, but can you give a small business owner just a rule of thumb? If a business is making $100 a year, what would be a reasonable number to spend on professional fees, right? You can't afford to spend $30 on professional fees, right? You're not making any money.
Sure.
But also you spend 20 cents, right? Because that's not getting quality service. So is there a rule of thumb out there? Look, if I'm doing a certain volume, my professional fee should be commensurate with that volume.
Yeah, I mean, I think that the general rule of thumb is about 1% of revenue.
Okay, thank you.
So that's one easy, quick heuristic. But again, every business is different, and there's levels of complexity. I know $30 million businesses that have tons of complexity, and $30 million that are simple as can be. So, where one of my clients, actually, I'll give you two examples. Both are about $35 million revenue, right? One had probably 7 different business lines, had a team of 7 full-time people, and that we oversaw came in, and we had a fractional CFO and a fractional controller that was probably, we're putting it about, 150 hours a month, right?
Can you just stop right there for 1 second? Can you explain the difference between a controller and a CFO?
Sure. So a controller is probably somebody who is going to manage all the day-to-day financial operations and reporting, make sure all the compliance is done, your tax filings, payrolls processed, all that kind of stuff. They're managing all of those processes. Your CFO is probably going to come in and do a lot more strategic work, do a lot of the projections, do a lot of the analysis of your financials, be a liaison with the CEO, with the board, help to deal with financing, funding, capital raises, things like that. Manage banking relationships, manage relationships with investors. So a lot of the more strategic and qualitative functions, I'd say.
Awesome.
Yeah. But just circling back, so this one $35 million revenue company probably spent well over $1 million on their finance function a year. Conversely, another one I'm working with now is probably spending about $60,000 to $75,000 a year, because they're just business as simple as can be. No complexity there. There's some work to do, but it's not overly cumbersome, and they're a high dollar, low volume revenue business. So it depends on the complexity.
So Chris, can you help the audience and help us give them some quick wins right now of what they can do to get better ROI on what they're already doing?
Yeah, I mean, I think two things I'd say, and I probably already said them, but I'll drill down a little bit. Automate, right? So if there's anything you haven't automated in terms of processes, look to automate it, and also look to build out. So with that comes technology. Make sure your technology is well integrated. So everything is seamless. Yeah, sorry.
Is there any technology that you like best? Do you like Xero or your QuickBooks?
I mean, a lot of people use QuickBooks. QuickBooks is so common, and there's so many plugins that work with that. You have your Bill.coms, and I'd also look to use an FP&A solution, so financial projection analysis. There's a lot out there, but just make sure they all plug in their seamless integrations so that you don't have to export data and import data, and make sure you're data validating as you do all this stuff with all your different systems. As they can integrate and run smoothly together, all the stuff syncs back and forth, so you don't have to worry about making sure your data is correct in all your different systems. So that's what I mean by integration. But with that, once everything's automated, I'd say for a lot of small businesses, what they're not doing is like a 13-week, so like roughly 90-day cash flow projection. Do that with the level of granularity of a weekly cash flows. You want to do 90-day projection every week. Do your actual versus what you projected. And I will tell you that as you see where you're wrong every week, you're going to get a lot of visibility into your business. You have assumptions about your business and how things are working and when things are coming in and when things are going out the door. And as you see that on a weekly basis, and it's not necessarily something you have to prepare, but you can have your CFO or accountant prepare it, but you're reviewing it with them, drilling down and understanding where those assumptions are and where you were off every single week, even if it's 5 or 10 minutes, you're going to get a lot of visibility into your business that you probably didn't have. And as you iterate over time, your assumptions get better and you understand so much more. It's the one thing that doesn't take a lot of time, but you get so much insight from it.
That's great. And what about cash or accrual, right? A lot of different accountants have different opinions. What's your breakdown? Can you explain them both to the audience?
Yeah, I mean, cash basis is really, I could pull your bank statement and say, this is how much cash came in the door. This is how much cash went out for the month. That's all cash basis is. It's all your deposits minus all your spending. But that's not really representative of what's going on with the business. A lot of businesses, for example, have, all right, so let me step back. That's cash basis. Accrual basis is more representative of what's actually happening with the underlying business, right? So there's a matching principle that we talk about as accountants to match revenue and expense, right? If I'm a software company and I sell you my software for $1.2 million, I'm going to, on an accrual basis, recognize revenue $100,000 every month over the course of the year. And the reason I'm doing that is to spread that revenue equally over that full year, right? Because on a cash basis, I got $1.2 million coming in January next year, but I have payroll all year long. So instead of having my books look like I have, I don't know, let's say my payroll is $100,000 a month, right? Instead of having $1.2 million in revenue and $100,000 of expense in January, and then having no revenue all the rest of the year, but I have $100,000 of expense, I'm spreading that revenue out on an accrual basis. So we match the revenue as it's earned over time with the expenses as they're incurred over time. So it gives you a better representative picture, even though the cash isn't necessarily transacting at those points in time.
Why does that matter to somebody?
I mean, I think it's helpful because for budgeting purposes, your business, let's go back to the cash basis, right? So if I have $1.2 million coming in January 1st and I'm spending payroll all year, January looks great. Like I got 1.1 million of profit in January, but I have $100,000 loss all the rest of the year. It gives you matching the revenue and expense helps you better understand how all the operations are flowing, not necessarily when the cash is transacting. And we got to keep an eye on cash. Cash is king, right? But at the end of the day, you want to have visibility into both because you want to be able to see what my whole operations are really, really operating like without that variance because okay, well, I collected all this cash this month, even though I got to earn it over the next year.
Chris, thanks so much for your insight, man. We want to be respectful of your time, and we appreciate you being here.
Yeah, appreciate it.
Do that. Can you tell everybody where they can reach out to you and
yeah. The easiest place is probably at our website, KWC Advisors. You can find me on LinkedIn. Those are probably the easiest two places. I can put my email in show notes or whatever if you want to do that.
We'll definitely do that.
Yeah, those are probably the easiest way to go.
Awesome. So give me one of your favorite tax strategies of all time before I let you run.
All right. So I would say that we talked about exit planning, right? A lot of people want to figure out a way to exit. One thing you can do is sell your company to an ESOP, employee stock ownership plan. Somewhat common, not often executed really well, but it allows an owner not only to not only sell and take the cash out of the business, but also generally retain a level of control to manage the business on a go-forward basis. So it's a really good liquidation event for them. That being said, the tax piece of it is, if you're an S corp, what you're going to do is you're going to set the company up as an S corp. It's going to be owned by an ESOP trust, but the ESOP trust is not a taxable entity. So all the pass-through tax of the S corp does not get taxed by the ESOP trust. So there's no actual corporate tax. Ultimately, the tax is going to be on the back end for the participants of the ESOP plan because it becomes a retirement benefit as the individuals take money out. But on a year-to-year basis, your S corp company is owned by an ESOP trust that is a non-taxable entity. So there's no corporate tax. I've always thought that was a good little trick.
I love that one, actually. It might be a little complicated for everybody.
Yeah, I mean, there's some complexity that's set up and done well, but it's one of the best solutions I've seen.
Well, let me ask you this, just for the audience right now, what size of a company would be able to pull that off? We're not talking about a 3 or 4 person company.
Right. I mean, you're probably on the low end. If you're a $25 million company, you can probably do something like that.
Awesome. Chris, thank you so much for your time.
Appreciate
you. Thanks for being here. Guys,
right.
The wrap of the Liquid Lunch Project. We'll see you on the next episode.
Thanks so much. I really appreciate it.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Lunch Project.